Brilliant. Welcome, everybody. I can see people joining us now, so I'm just going to give it a couple of minutes because it's not quite 10 yet, and I'm just going to give people a chance to get into the session, and we shall crack on at 10. Welcome to those of you that have just joined us. We're just waiting. If you can't hear anything, it's because we weren't speaking. We're just waiting till 10 o'clock just to give people the opportunity to make sure they're on before we get started. Okie dokie. So I would hope there's going to be some other attendees that do join us because we're still a little bit down from, yeah, I've got a couple of people still coming in, good. We're still a little bit down from where I thought we'd be, but just with one eye on time, I think it might be best if I get started because it's Henning that's got the content you're really here for. So if people are still joining at this time, I don't think it's mission critical. First things first, my name's Alison Bonathan. I'm a technical manager at SIPFA, which means I'm part of our standard setting team. So my main responsibilities are things like standard setting for the charities sector in the UK. I'm also involved in the international team as part of our anti-corruption suite of products. Henning's going to introduce himself shortly, so I shan't do that right now. Instead, I'm going to just talk about logistics. This has been set up as a webinar rather than like a meeting. So things like your microphone and your camera aren't necessarily, well, they're not going to be working. And there isn't a chat panel. So if you do have questions, you can see a Q&A panel there that you can pop those questions in. We do have time for Q&A at the end, so I'll be keeping an eye on the Q&A panel, and then once Henning finishes his presentation, I will be discussing some of your questions with Henning, so do keep those coming in. I can see we've already got someone saying hello to us on there, so hello Prabin, lovely to have you with us. But yeah, Q&A panel with any of your questions, type them in as we go, and then we'll get to them at the end. And yeah, so I'm doing logistics and also a brief introduction to SIPFA. So SIPFA is the only professional accountancy institution in the world with responsibility for public sector and with a sole focus on public sector accountancy and public financial management. And we do have an international remit. So we're an international membership organisation. We're based in the UK, but we very much do have a global outlook. In the UK, we do things like I've just suggested, standard setting supports the UK local government sector. But we do have an international presence with members across the globe. So SIPFA internationally does offer qualifications to provide a firm foundation in a career in public financial management. And I've just popped up there some of the popular qualifications that we've got candidates for and members for across the globe. And you can see there that relevant to today's session, we do training in IPSAS. So yeah, we've got these popular programs. We've also got a couple of programs in development that you might be interested in. We've got a program in performance audit currently under development. So that's looking at things like value for money. And we've got a program called the International Certificate in Corruption Risk Management in development, which is related, that's the one I'm working on, related to the anti-corruption agenda, and training professionals across the globe to be able to conduct corruption risk assessments in their organisations. As well as offering qualifications globally, we also have an advisory team that works with organisations across the globe to develop their public financial management capacity. And I've just put some of the examples of what we do. I've just, selected some of the examples of some of the things that we do. So this is one of the pieces of work, just to give you a flavour for what we're doing internationally, really. I've forgotten something I've not said. Hang on, I'll write that down so I can say it before you start, Henning. So we've been working with the Auditor General of Pakistan. The work that we've been doing here is we've been training members of staff in the department of the Auditor General of Pakistan in our professional qualification, which is our chartered accountancy qualification that we offer. We've trained 150 people of members of staff in that, and these are donor funded projects. So that has been, donor funded. And we've been delivering training in performance audit. So like the value for money training, not the qualification that we're currently developing because that's not ready yet, but other training in performance audit to a further 800 members of staff in Pakistan. We have been working, wrong way. We have been working with Rwanda. So in Rwanda, we've been developing a computer-based qualification to support public financial management practitioners to obtain formal qualifications and, importantly, public sector-specific qualifications to support the development of public sector institutions in Rwanda. In Albania, my mouse is going the wrong way for some reason. Apologies for this. I'll have to click instead. It's more reliable. There we go. In Albania, we've been developing public accounting skills, as you see. What this project's involved, again, these are all donor-funded projects. What this project is involved working with both central and local government departments to improve the understanding and application of IPSAS, which is why I've selected it as an example for today's presentation. And this is among key experts in institutions, including the Ministry of Finance and Economy. So what this project is intended to do is, yes, train the people themselves, but also train them in methodology, in training methodology, so that it becomes a self-sufficient team. So there's a self-sufficient core team with the knowledge and the skills to pass that knowledge on to other people, so that Albania have now got the capacity to develop fellow professionals in their finance teams. And the final one I've selected, just to give you a flavour as to what we do at SIPFA, is a public financial management education and training programme in Somalia. So this is working with local universities and consultants to ensure that people in Somalia have the capability and the capacity to deliver SIPFA qualifications. So it'll be the same exams that we set, but the training is delivered by local people in Somalia, and there's a computer-based element to that training as well. Alrighty, so I just wanted to give you a bit of an introduction to SIPFA in terms of what we do, which hopefully you've got a more of a flavour for what we do, particularly internationally. We do have a strong presence in the UK as well, which is a lot more local government focused, but hopefully that's given you a bit more of a flavour relevant to the IPSAS presentation of what we do internationally. The thing that I forgot to say in my little intro is we are recording this webinar. So you should have had the little warning as you join the webinar that it's being recorded. It is being recorded. So if that's an issue for you, then obviously you've got the opportunity to step out. Otherwise, I'm going to hand over to Henning. Do keep your Q&A coming in and I'll have a little read through them and we'll go through them at the end. But otherwise, over to you, Henning. I'm looking forward to this.
Let me unmute myself. So thank you very much. And yeah, thank you all for attending this webinar on IPSAS and the IPSAS board. Let me just share my screen and get into my slides. Here we go. Okay, we're just waiting for the slideshow to start. I mean, I can make a start just by saying, so I'm also a technical manager, but at ICAW, so that's the Institute for Chartered Accountants in England and Wales. Let me just, here we go. And so I qualified in roughly 2008, and then my first job as an accountant, I worked at Barclays Bank, which was interesting, but I only did that for 3 years. Then I moved to the Treasury. I was there for 5 years, and then since 2015, I've been at ICAW, and similar to Alison. So my remit is to look at the technical standards, and in particular the IPSAS standards. So that is my background. So I just to let you know as well that I am the technical advisor of the UK board member on the IPSAS-B, and the UK board member is Lynn Perment, and she also chairs the FRAB, and the FRAB is the Financial Reporting Advisory Board here at the Ministry of Finance, and they look at the accounting standards for the public sector. So hopefully I'll be qualified to answer any questions you might have later. So about today's session, so I've got more or less half an hour, and the first two topics are just to have a brief look at some of the newest accounting standards that the IPSAS board have recently announced, and then the next part, so from 3 to 6, is then to look at the sort of sustainability landscape, and in particular what the IPSAS-B are doing in this space. Okay, so with no further ado, let me just crack on. I would just also like to say, I think today is a bit of a mixed audience, so this is not particularly a technically heavy session. I will go into it if people want to, but I'm just going to keep it more higher level. So anyway, so the first one that we're doing is IPSAS 44, and that's the non-current assets held for sale and discontinued operations. And essentially, really, why they did this was there was a gap in the IPSAS literature, and secondly, the IPSAS didn't have the equivalent of IFRS. So at a fundamental level, the IPSASs want to have the equivalent standard to IFRS, and then if there is a public sector specific standard that is required, then the IPSAS would have over and above a standard over and above what IFRS have. But that's the basic premise, and I've got to admit, I'm a big fan of that, because I moved, as you know, from the private sector into the public sector, and if the public sector were to use something completely different to IFRS, I wouldn't have been able to make that move. So I think from a movement of people point of view, I think that's a very important point to bear in mind. So what is this standard? So essentially, we're talking about the disposal of non-current assets and also discontinued operations. But the reason why I've not put discontinued operations on here is because I've actually never seen that happen. So if you think of the public sector, they don't ever discontinue a service. If anything, if the services do move from one government body to another, but that's not the same as discontinuing a service. So that's why I've not put it on there. I did come across it once in my professional career, and that was at Barclays, where we got rid of the asset management unit, and we had to then do this whole discontinued operations accounting, and let me tell you, it was pretty complex. So just coming back to this, so in my experience, I have seen disposals of non-current assets to a limited extent, so it's not really material. It tends to be the Ministry of Defence in the UK. And the last time I looked, it actually related to buildings, old military buildings that they had in Germany. So as the British Army are pulling out of Germany, they are looking to sell their buildings, and some of those buildings were put up as non-current assets held for sale. So some of these benefits to doing this is increased transparency. So wherever you have a lack of a standard, and when jurisdictions do their own accounting, you have issues with comparability, etc. So this should increase comparability and transparency. So the scope, if you look at this slide, the scope is deliberately, basically we haven't transgressed from the scope of what is in the IFRS equivalent. So it's actually IFRS 5 is what this standard is built on. And IFRS 5, like all IFRSs, are based on commercial transactions. And if you look at this scope, so, the current amount, i.e. you have to essentially sell the asset, it has to be available for immediate sale, and the sale has to be highly probable. These are all pretty commercial related scope criteria. And for the sale to be highly probable, the management must be committed to sell it, there has to be an active program, and the price has to be reasonable. And it says here the sale is expected to be completed within 12 months. Now, I had a call from the Ministry of Finance here recently, and they said, oh, basically with this 12-month criteria, because there is a extension, you can actually extend that criteria above 12 months if the circumstances are out of the entity's control. And the Ministry of Finance here thought that that was an IPSAS specific reason to go against this 12-month, but it's actually also an IFRS 5. So that is not public sector specific. So the standard does say if you can't manage the sale within 12 months and the reasons are out of the control of the entity, then that's okay. You can still account for it under this standard. Okay, just moving on. So how to account for it? Just very briefly. So immediately prior to classification as held for sale, the carrying amount of the asset measured is in accordance to the relevant IPSAS. So that is predominantly going to be your property, plant and equipment. So if the asset is at historic cost, you would depreciate and impair it as needed. And for current value assets, you would revalue the asset prior to holding it as held for sale. Then when the asset is held for sale, it is measured at the lower of the carrying amount and fair value less cost to sell. So bizarrely, so it's not bizarre, but so basically if your asset is already at current value, so the carrying amount is already the fair value of the asset, then when you classify it as being held for sale, the only difference will be the cost less to sell. So you might then have to lower or reduce the carrying amount according to the costs less to sell. But alternatively, if your asset is held at historic cost, and if that historic cost happens to be higher than fair value, and I've got to admit that it's going to be pretty rare if you think about it, then you would have to reduce the amount. So if your carrying amount is higher than the fair value, obviously it has to be at the lower of the two, then you would have to reduce it to the fair value. But in most probably, like I said, the carrying amount will be less than the fair value. So coming to presentation disclosures, there's not really much to it. So your non-current asset, when it is held for sale, will move from non-current into current. But there is one public sector divergence, and that is that you are going to have to show, so if your carrying amount is less than the fair value, and if the fair value is then materially different, you then have to disclose both values. That is not something that you'd have to do under IFRS. And the reason was for transparency reasons. So there were some board members, predominantly from Latin America, who were quite concerned that some of these assets are sort of sold not at arm's length, if you like. And so if they're being sold on the cheap and they're being sold to, say, business associates or being sold to sort of family members, then nobody would know. So by comparing your sales value to the fair value, you hopefully try and minimize the risk of any fraudulent activity happening in that space. So that's why we came in there for in additional accountability in the public sector. Okay, let me just move on to the next topic now. Just see how I'm doing for time. Okay, leases. So the leases standard at the moment, it's still ongoing. So we've just sort of published the IFRS 16 equivalent, but there are still some public sector specific issues that are being worked on. So this topic, I'm going to tackle it more from a PFM point of view. So, if you look at leases, you have your sort of asset management, your cash flow, and then you've got your off-balance sheet considerations to take into account. And really, when it comes to asset management, it's a bit like having, you have certain considerations to do. So if you own the asset, then if the asset breaks, then the onus is on you. And often under a lease agreement, if the asset doesn't function, then you'll have automatic maintenance criteria coming in. And it's the same with obsolescence. So if the technology moves pretty quick, you're not lumbered with an asset that you've purchased and you have to use it for the next 10, 15 years. If the technology changes, and you have a 5-year lease contract, at least you're only in it for 5 years. There may also be some break clauses that would allow you to exit the lease agreement prior to the 5 years. In cash flow terms, it's no different to you making a decision to buy or to rent a car or to lease a car. You know, it's very much the same considerations. If you buy an asset, you have the upfront cost, but then obviously you own the asset and you have, you know, you've got certain balance sheet considerations, and you obviously have a residual value that that you can then sell. So you have a value on your asset. When you lease an asset, you don't own the asset as such, but then equally you don't have the upfront costs of buying it. So these are the sort of basic principles that a person would apply, but also a business. And then finally, you know, we have to remember that back in the day, all the sort of operating leases were off balance sheet for the lessee, and that is no longer the case. So just very quickly in terms of project history, this project was initiated in 2016, and it was billed as a sort of IFRS 16, you know, equivalent project. So we wanted to adopt. But when the IPSAS looked at the actual standard in more detail, there is a disconnect between the accounting that the lessors do and what the lessees do. So the lessors are stuck on the old model, which is risk and rewards based. So they will still look at operating in the finance lease, and the lessee will be recording a right of use asset. And there is a disconnect there. And they said that this disconnect is difficult for the public sector due to consolidation. So a lot of public sector bodies do consolidate. And when you have a mismatch in accounting, it makes it more tricky. And then there are some other reasons, such as the risks and rewards models for lessors is not actually compliant with the conceptual framework, which is more based, which is controls based. Okay, so there's a conceptual difficulty there as well. So they try to change the lessor's accounting to mirror the lessee's accounting, and they issued a exposure draft in January 2018, and suffice to say, it didn't work out. Basically, what they were proposing didn't go down well with the constituents, and it was pretty much rejected. And then in January 21, they said, okay, if we can't come up with a different solution, then we're just going to mimic the IFRS 16 leasing standard. And that's what they issued in 2021. And then literally within a year, they were able to then publish the leasing standard, just because it's based on IFRS 16. So it then moved quite quickly. So why update the standard? I mean, I've said this quite a lot of this already. I think, like I said, it's always good to be aligned with IFRS 16 or with IFRS standards. I think the lessee's point of view is very important, because the fact that the lessees now have to record a right of use asset means that their leased assets are always on the balance sheet. I think that's quite important. I do think you can massage a balance sheet to make it look better than what it should be, and it improves comparability, because whether one entity has bought an asset and the other one has leased an asset, essentially both of them will be on the balance sheet, and it becomes more comparable. So this is the problem we came to with the group account. So like I said, you have different lease values between the lessor and the lessee, and this is actually magnified if the lease is at a concessionary basis. So if it's below market rate, it then exacerbates the problem. The only, what we've seen, and in the UK, and I've seen it in other jurisdictions, you often have one entity that manages the entire estate within the public sector, or at least a large part of the estate. So in the UK, we have a relatively new body that looks after the central government's estate. So in one sense, if you have a consolidation mismatch, at least it's sort of contained within one entity rather than being spread across multiple entities. And I have to say also, historically, there hasn't been that much attention paid to leasing standard, just because people got used to it and it's worked. But I think that might change now with the sort of differences on consolidation. Now, I've spoken to this with quite a few of my fellow technical advisors on the IPSAS board, and the general consensus is that you would have to unwind all the lease-related entries in both the lessor and the lessee, and then reinstate the underlying property, plant and equipment. You will not be able to eliminate in the traditional sense by letting the system marry up the debits and the credits and eliminate automatically. We think the values will be too dissimilar, and then you obviously then have differences depending if it's an operating lease or a finance lease on the lessor's side. So to write a accounting software, to write a program that can mimic a standard process would be extremely difficult. So in our view, I think you'll end up having to unwind all the entries and then reinstate the underlying property, plant, and equipment, along with the depreciation and any impairment that it has. So that's how you go about that. Okay, so just what next? So as I alluded to earlier, we are still debating how to account for concessionary leases. So concessionary leases are essentially leases below market value, and in some cases even for zero consideration. So I'm actually off to the next IPSAS board meeting next week where this will be debated. I think there is still some issue a little bit on initial recognition and subsequent measurement, essentially. And it's all around fair value and the appropriateness of fair value, because historically, when you have something coming in at deemed cost or at below market value, you would apply the fair value recognition mechanisms. But there are some issues with that, and in particular around highest and best use and the market application. And we don't think that all the, in all circumstances will this be appropriate for the public sector. So I can't really say much more than that, just because it's an ongoing debate. But hopefully early next year there'll be a new exposure on this, and you can all see. Okay, so this then brings me on to, let me just see how I'm doing for time. Okay, then this just brings me on to that sort of final bigger topic of looking at sustainability. So I'm going to just have a few introductory slides, and I'll be building up to what the IPSAS board are doing, right? So I just wanted to share some context, because I'm not quite sure how familiar you are with this topic. So first of all, ESG, I've just put this up here because it's a term that's being used more and more often. And actually, what does it mean? So if you look at the, you have the definition there on your screen, which I quite like, and it, to meet the needs, so sustainability to meet the needs of the present without compromising the ability of future generations to meet their own needs, which I find is quite a neat way of looking at sustainability in general. But coming back to ESG, so you've got your environmental factors, your social, and your governance. Now, under environmental, it can be many things, but primarily we're talking about greenhouse gas emissions, so that will be your CO2, but there are other gases as well. It could be things like recycling rates, it could be water usage, etc. And what do we think about under social? Well, that can be all manner of things. It can be like the sort of health and safety record or health and safety standards of your products. It could be things like your supply chain labor. And it can also be things like your employee development and just your general labor practices, such as, are you paying a decent living wage, etc. And then under governance, how a company is led and managed, and what we often then look at is whether they have specific management functions in relation to sustainability, and in the private sector at least, whether senior management have got if any of their pay structures are linked to sustainability. So we would like to ideally see bonuses being linked to improvements in, say, greenhouse gas reductions, emissions, things like that. That's what we often do with governance. So how does this all fit together? So in my view, you've got sustainability, ESG, and climate, and I think, well, I'm pretty sure that these terms are actually used sort of intermittently in any case. But the way I see it is that sustainability is the big, broad, encompassing umbrella, and that is most relevant to the public sector. Then you have ESG, that we've just touched on, and that's generally speaking targeted at private companies, because it's something that the investors are very keen at looking at. And then an example of what could be within sustainability and within ESG is climate. And the reason why climate is often mentioned is because we talk about the climate crisis. So the planet is heating up, and that's causing changes in weather, which is affecting humans directly. And that's probably the most acute threat we're currently facing. There are others, such as loss of biodiversity, etc. But climate is probably the most imminent risk we are facing. So the IPCC, that's the Intergovernmental Panel on Climate Change, they've come up with this dire warning that if we go above 1.5 degrees warming of the planet, it'll have X, Y, Z consequences. And unfortunately, we are heading way behind, but way ahead of 1.5, and we've got to look at what the world would look like with 2.5 degree warming. Okay, but that's how I look at these things. And just one last thing with sustainability, it looks at sustainability in every sense. So you've got your financial, economic, environmental, but sustainability is not just the impact of the climate on an entity, but it's also the other way around. How sustainable is an entity in relation to the environment it operates in? And for me, that is a key government criteria, because the government is there to sort of act as a custodian for future generations, right? We want to leave the planet in such a state that our children can still enjoy the wildlife that we've had, and don't have to live, in constant fear of drought or fires and extreme weather. Okay. So why does sustainability matter in the public sector? Well, in most jurisdictions, the public sector is just simply massive, right? So they often, on average, they contribute 40% to GDP. They have a huge workforce, and they own a lot of land and buildings, right, in some instances. So really, they are, if you like, quite a bit large emitter of climate emissions themselves. So if they were to apply the policies directly to their own estate, they would make a difference. So in one sense, I would like to see the government lead from the front. I know ultimately it's the private sector that will have to come up with the solutions, but really we'd want to see the government play a key role in that. And the other one is, the government is ultimately the regulator as well. So, being a chartered accountant working for ICAW, I often look at the reporting standards and see what impact they might have. But let's be honest, right? If you really want to reduce emissions and make a difference, well, just regulate. You can ban diesel, or you can ban fossil fuels in the UK. The cars will be banned, I think, by 2030, and then will be phased out by 2030, and by 2035 there'll be no more new sales of fossil fuel cars, just as an example. So the government really do have the power to make a difference. So I just wanted to show this one, just to look at some of the hidden effects of climate on an economy. And if you think of a private company, right, they kind of just have to worry about the bottom line and maybe look at their reputation, etc. But if you are in government, you've got much broader responsibilities, because not only are you there to ensure prosperity for your citizens, but ultimately you're also there to ensure that the climate remains healthy. So what I mean, I'm not going to go through all these points on the slide because you can read them yourselves, but there are certain sort of feedback loops, and this is the terminology that's used in this sort of climate related thing, but really what it really means is sort of unintended consequences. And one thing that struck me was, we've in Canada actually, and it was last year, they had a huge heat dome sitting above Canada, and the temperatures were between 40 and 50 degrees centigrade, and that is like sort of 20 centigrades above normal. And it had a huge impact. So the houses weren't equipped to deal with it. So people had to sleep in sports centers or in schools where the air conditioning was. The productivity took a massive hit. But what else happens when you have these massive heat events, right? So I know in the Horn of Africa, for example, they've got the 40-year drought, like the worst drought in 40 years, sorry. That's in sort of Ethiopia and Somalia. And it's having devastating impact, not just on the wildlife, but on the crops, but it will then have an impact on the health of the population, children getting diseases due to malnourishment, etc., etc. People having to walk a lot further just to get water and food, and again, stopping them from being productive in producing other goods and services. We've also seen, in the UK, we've had some very extreme hot weather, and a lot of our offices are just not equipped with it. So we have a lack of air conditioning, which means productivity is dived. Our transport network doesn't function when it gets too hot, because the metal railway lines start buckling, and also the overhead electric cables start sagging. So the trains don't run. It was so hot that the tarmac was melting, and airports were having to close down because the tarmac was too soft. So all these events, that that ultimately will hit government hard. So just coming onto the sort of climate reporting now, and really what I wanted to show you is a bit the sort of the land, like give you an overview, give you a flavor of the landscape that there is. Let me just move on. Okay, so this is a very busy slide, and I don't normally like to have them as busy as that, but it just paints a good picture of how complicated and how messy the situation is. So you have the International Sustainability Standards Board. These are the latest guys. They were announced at COP26, so that was in Glasgow last year, and this is a offshoot from the IASB, so the guys that produce the IFRS standards. These have now produced 2 draft standards, S1 and S2, based on climate and sustainability. And the idea was, or the hope was that other frameworks would amalgamate and sit under ISSB. Okay, and the only example of that actually having happened is the Value Reporting Foundation. So before, you had the International Integrated Reporting Council and the SASB, which is the Sustainability Accounting Standards Board, which are the American. They've basically merged to form the Value Reporting Foundation, which in itself is now sitting under ISSB. So that was a good start. However, there are a number of other frameworks still out there that have no intention of merging with ISSB. So these are in particular, this is the Global Reporting Initiative, and then also there are standards coming from the American Security and Exchange Commission, and also the European EFRAG. They have also just announced their own sustainability standards. So really what I wanted to say is that I think from a public sector point of view, it makes it quite tricky, because you want to align yourself with the most prominent reporting out there. You know, it's no point of being a sort of an outlier where you're sitting on your own. It is still a moving picture. But in our view, we think that the ISSB standards will be the sort of the global baseline standards, and that you'll then have other sort of niche standards sitting alongside, if you like. That's what we're hoping that will end up happening. So a lot of the standards are actually based on the TCFD requirements. So that's the Task Force for Climate-Related Financial Disclosures. And they split the whole reporting on climate and sustainability into the sort of governance, strategy, risk management, and metrics and targets. So really under governance, you would expect to see the sort of board's oversight of climate risk and opportunities, and a description of the management's role in that space. And again, with strategy, it's a sort of description of the risks and opportunities over the short, medium, and long term. And then risk management, yeah, you've got to identify the risks and opportunities, and also and this is quite important, and how specifically the climate risks are integrated into an entity's overall risk management. And then finally, with the metrics and targets, the key one is on greenhouse gas emissions, which are split into scope 1, scope 2, and scope 3. And these different scopes, so scope 1 is your direct usage of, or your direct emittance of greenhouse gas. And then scope 2 and scope 3 are indirect measurements. But the metrics and targets can include, you know, things like water usage, recycling rates, etc. There's no set rules on those. So just coming back to the model itself, obviously we will eventually see the impacts hitting your financial statements. It hasn't happened just yet, I have to say. We are not really seeing many entities change the valuations of their assets or liabilities due to climate, but we are expecting this to happen in the near term. And when you just look at the sort of transition risk and physical risk and opportunities, you know, really on transition risk, the key ones will be obsolescence. So when technology will no longer be usable, and that's primarily fossil fuel based. So you have your vehicles as a good example. And then the cost to transition as well. So maybe having to install solar panels, etc. And then finally, if the reputational risk, which could be quite high. So if you're not seen to be moving with the times, or you're not seen to be helping the planet, you know, especially amongst younger people, that could have consequences on your ability to sell products. And then on physical risks, these are primarily due to extreme weather events. And I've got to admit, so with acute and chronic, so the difference is, so on the acute front, you've got your one-off weather events, and when it's then chronic, you've got your rising water levels. They're the sort of key examples. Just wanted to move on. So here I've actually created a slide where, in a bit more detail, how could climate or sustainability actually affect your non-current assets? So predominantly think of your property, plant, and equipment. And in sake of time, I don't want to go through all of these, but so just the top one, in case you're wondering. So when you have a building and you decide to improve it, say, I don't know, with an extension, then you can capitalize that expenditure, right? And you will increase to the asset. However, if that building is not due to, I don't know, let's just say that building sits near the coastline and it's due to flood and it becomes unsustainable, so you can't get insurance for that building anymore. And if you then decide to extend that building extension, you may not be able to capitalize it if it no longer fits the definition of a long-term asset. So then you would have to expense it. But where we're expecting to see the most changes is in the change in the estimate useful lives of assets. So we've seen, due to extreme weather, we've seen the lifespan of certain assets come down massively. So again, if you have a building and it's in the floodplain, and it might become unusable in 10 years time, but if you had an expected useful life of that building of 30 years, yet within 10 years it's just going to become flooded more and more often. And let's just say that building is a warehouse, and that warehouse cannot afford to get wet, depending on what's in there, then your lifespan is only 10 years and not 30 years anymore. And then if that happens, then you have to impair your asset because your estimate useful life comes down. Okay. So coming on to back to the International Sustainability Standards Board, I just wanted to show you a little bit the applicability for the public sector and what concerns we have about it. And this lists out all the issues that we have. So the ISSB standards are focused for the investor. It says it in the standards, these are written for investors. Now, the government doesn't have an investor, and investors are interested in the impact that climate has on the entity, right? Because that's where their money is going to sit. They're interested in the bottom line. Now, the public sector doesn't operate to the bottom line. It is not profit orientated, and nor does it have just investors as stakeholders. There are some investors, because obviously when government issue bonds, like they do borrow money. So there are some investors in government, but the stakeholder base is seen to be much wider than what the ISSB standards are written for. And that comes back down to the second point. And I've written up here double materiality, because that is a term that's used in Europe to explain the difference of the impact on an entity and then the impact that the entity has on the environment itself. And the GRI standards, so the Global Reporting Initiative standards, they are actually probably, just on the face of it, more suitable for the public sector because they do have this double materiality concept, and they also are written for a wider stakeholder group. And then just this bottom one, what I've written in there, it's basically, if you look at some of the disclosure requirements that the ISSB are looking for, they are looking for forward-looking models, which is called sort of scenario analysis. And some of them could be quite long, like forward-looking for quite a few number of years. Now, the problem for the government is, because they are a regulatory function, to what extent does a prediction, to what extent can you then self-fulfill a prediction or not? So say your scenario analysis was for all fossil fueled cars to be eliminated within 10 years. Well, obviously the government in one way has the power to make that happen, or it has the power not to make it happen. So it could become politically quite sensitive, so if one entity says, oh, we predict that in 10 years time, there'll be no fossil fuel cars, then, another part of government might say, well, hang on, we weren't planning on that because we still need to rely on the fossil fuel. So it can become politically quite an issue. and it could also become sort of self-fulfilling. So I think that's an area that the government would need to look at a bit more carefully. So then finally, it brings us on to the IPSAS board development. So there was a consultation out last year to see what they should do, and I can say that the overwhelming response is positive. So constituents say that the public sector needs to be active in this space, and that the IPSAS board should be developing a framework stroke standard. So that's the easy bit. The hard bit is how, and what this slide basically says. Well, you've got two options, right? So full reliance, you could just copy what the ISSB or the GRI are doing and change the terminology a little bit and then make it for the public sector. So that would be the least amount of input and the quickest outcome, if you like. And then on the other extreme, you would just start from scratch and say, well, we need to, you know, the public sector is so different. We need to look at it from bottom up and create something brand new from scratch. And then obviously that would be the most intensive resources. I think for me, the answer is somewhere in the middle. I think they should rely on some of the work that's already out there. I think some of it is very good, and some of it is obviously backed up by scientists as well. However, they do need to look at the public sector context, and for me in particular, is the outward-looking impact. You know, governments have a responsibility to safeguard our natural resources for future generations, and that should be an overriding factor. And one of the key concerns about in all of this is actually the level of expertise. Now, the IPSAS board I think there's about 18 members from all parts of the world. They are very good at financial reporting. They're very good at the back end of the annual report. So they're very good at the financial statements. But what we're looking at is more the front half, you know, and it's a different set of skills you need. And we're just a little bit concerned of how the IPSAS board can get those skills. I think there might be some additional funding, and they could increase the, you know, they could buy in some specific staff to look at it. But ultimately, the standard setting happens at the board level, and it's the board level as well that needs the expertise. So I think that's going to be the major constraint in this. And then just finally, I just want to touch upon another project that the IPSAS board were looking at last year, and that's on natural resources. And I highlight this because it sort of showcases the difficulty of this topic, right? So these are split between subsoil, so your sort of, you know, your oil, your gas, your, you know, anything that's below the ground. Then they were looking at water, and also then living resources. And when you look at it, right, so each element had some problems about it, and the problem really was that in most cases they didn't really meet the definition of an asset. Okay, so the problem with subsoil was one of measurement and uncertainty. You didn't know the quality that was there, you didn't know the quantity, etc. So there was too much uncertainty. And then the main problems with water and living resources was a question of control. You know, can you control flowing water? It evaporates, etc. Living resources, you know, especially with animals, they move around. But again, also with say a forest, another problem is that they have to provide you with economic gain, or they have to deliver a service, right? And you know, the way a forest can deliver economic gain is by cutting it down into timber, but then it's no longer a natural resource, right? So can a forest just on its own be, you know, give you monetary value? And that is something that needs to be discussed in more detail. I must admit, I think in my view, you know, for example, the Amazon, I would love to see the Amazon have a value just in its own right. I think if you said to most people, do you think the Amazon is an asset of the world? I think most people would say, yes, it is. But then why is it not on the government's balance sheet as an asset? You know, it's just because of the way it's the way that the assets are defined. I think we need to just look at that and maybe tweak it slightly, so that we as humans can value nature as intended. You know, it doesn't always have to be converted into something that you can consume, you know. So that's my line of thinking. But it's an interesting space to go ahead. So yeah, anyway, that's where we're at. And this actually then brings me to the end of my presentation, and I'm looking forward to some Q&As. Thank you. Let me just stop sharing.
Thank you, Henning. That was So interesting. Prabin, I don't know what's going to happen with the recordings of the PowerPoint, so I will, I'm sure one of my colleagues from CIPFA will be able to answer that. If not now, then later. So apologies. If you've got any questions related to the to Henny's presentation, please do pop those into the Q&A panel. We don't have any coming in just yet, Henning, so that means that I get the lovely opportunity of asking you all of mine. So I found that absolutely fascinating. Like throughout, I mean, I'm a financial reporting person, so it really did float my boat when you were talking about IFRS 5 and things, but the climate stuff as well, super important, like you were saying. And when you were discussing IFRS 5, so sorry, I can't remember what the actual IPSAS name is. That's terrible, isn't it? So I'm talking about the assets held for sale. I found it fascinating that you were saying that the Latin American countries had requested that there might be additional disclosure of fair value, just to avoid the risk that if they are being sold off on cheap, the public wouldn't find out about that. And I honestly thought, why aren't investors in actual private companies saying the same thing? Because that can't be a public sector specific risk, surely. Have you got any thoughts on that?
Well, it's a good question. I mean, what I didn't say, and this happened at discussion level, is what some people were actually looking to be even more extreme and only allow fair value valuations of assets held for sale, so that you don't even get into that, that potential disconnect between the actual fair value, what you might obtain, and what the value is held up as being what it's going to be sold for. But the reason why we didn't go down that route is because we didn't want to have sort of day one gains, if you like. So if you record it at fair value and you're uplifting your assets, say from historic cost to fair value, you then record a day one gain and you haven't even sold it yet, and it might take more than 12 months before you realize the actual fair value that you said you might get for it. So that's why we've stuck with that. You know what, I think it's a good question. I just think in the private sector, generally speaking, when we're talking about IFRS, they are applied by larger listed entities, and I just think there's more scrutiny around them. So this whole analyst community, they would catch wind of it, and they would, and you have shareholders. So you've got people that are with more vested interest to see what actually happens in the detail, and they understand the detail better. So I think a lot of the users of government accounts, they are not financial experts. They are interested in a sort of bigger picture, and they wouldn't get themselves into that nitty gritty. Oh, look at that, the carrying amount and the fair value are very different. Let's just find out what they actually sold it for. So I think in that context, I would probably answer it that way. But it's a good question. Maybe I've got to admit, a lot of the adaptations in IPSAS, you think, oh yeah, that is just public sector. IFRS don't need to think about it. I think in this particular one, I think they should, they might as well pay heed to it, because I don't think it's an onerous additional disclosure to make, right? So carrying value versus the value you expect to get.
Yeah, no, absolutely. Actually, you know what? That's a really good point about there's more scrutiny from the analyst community, etc. That's fair, because I was thinking about related party disclosure, but I thought they're not, might it be easier to have it next to it? But yeah, you're right about the analyst. That's a really good point. Do you mind so IFRS 16 also piqued my interest. Well, the whole thing did. I just found it fascinating. Oh, we've got Victoria. I won't push in. Yeah, so Victoria's asking, decisions and strategies in one jurisdiction often have significant consequences in others, often poorer ones. This seems a complex area. Have you got any thoughts on how this could be managed?
So when we say jurisdictions, do we mean literally from like decision in one government will affect another government?
That's how I'm reading it, yeah. Oh, and Victoria's saying yes also. Okay.
I think, yeah, it depends a bit on what we're talking about. So I think in say pure accounting standard, probably not so much, because jurisdictions have got the autonomy to dictate what they're going to do. And we see that with the IPSAS, for example. So in many cases, when they say, oh, we're IPSAS compliant, they're actually just used as a reference point, and jurisdictions like to have that autonomy to then make adaptations themselves, and that's fine, right? But I think when it comes to sustainability and the climate, I do think there is a connection there, and you have the global north and the global south, how it's often described, and I think, you know, with COP27 as well. I mean, these are just my own thoughts, right? As I'm answering, this is maybe not the RCW view, but I am in favour of some sort of fund, whatever you want to call it, to help the global south fight climate. You know, and a lot of it. So if you look at ESG, the S is often just forgotten about. And when I had a meeting with the IPCC, so these are the Intergovernmental Panel on Climate Change, right? They were talking lots about social justice and essentially poverty driving a lot of these climate related issues in the global south. So there's no point in some jurisdictions, you know, being quite righteous and sort of saying, oh, we're going to phase out fossil fuels. It needs to be bit more of a global view on this, in my view, because, you know, the climate issue affects us all, and unfortunately disproportionately in countries that don't have the means to make much of an impact themselves. So I think, you know, you've got your mitigation but also your adaptation, right? So we've got to help countries adapt to what will be difficult times ahead. There's no doubt about it. You know, I've seen the stats and the projections. The weather will get worse, without a doubt. Sea levels will rise for the next, at least the next 100 years. So even if we stopped all CO2 emissions today, the sea levels will continue to rise for at least 100 years, and that in its own right will have impact on the weather. So I think, I mean, sort of answering in a roundabout way, but I do think there needs to be some support going more or less from the north down to the south, if you look at it that way.
I agree with you entirely on that, and I think I was going to ask you, and I will ask you. Oh no, we've got another question coming in. I was going to ask you. Oh, that's just Victoria saying thank you. You're welcome, Victoria. So I was going to ask you about the social thing as well, which I'll do in a minute. But from what you were just saying, it reminded me actually of some of the work that we've been doing around corruption, and so, for example, there might be decisions taken by supranational. Not natural, it's not Marvel Universe, but supranational bodies to, for example, if there's like aid going to a country, there might be conditions attached with that. And we've seen, for example, where there's conditions attached to public sector salaries, this might artificially keep down public sector salaries, which then creates a motivation for corruption. So I think yeah, I completely agree with you that climate's the big thing, and it was definitely the first thing that cropped up in my mind as well. But I think there's a wealth of examples that we could have talked about on that. But it does remind me that the social aspect of this, I think I agree with you that social sometimes gets forgotten. I think what you said about climate being the pressing emergency, I totally agree with you on that. But the social, for me, I find can't be ignored, because it's certainly some of the SDGs, like the UN's SDGs about gender equality, etc. If you look at some of the responses to COVID, for example, they were incredibly gendered. And I wonder if more emphasis on social aspect of reporting would support improvements in that respect. Is the IPSAS board doing anything? Is the social aspect on its agenda, do you know?
Yeah, that's a really good question. And I'm in favour of wider reporting on the SDGs. You know, I know in the UK we have got gender gap reporting and diversity reporting, which is actually coming from the company's company house law, you know, company law. It is important, and I think there should be more of it, basically. And I just wanted, before I come back to what the IPSAS are up to, so I think one of the criticisms a little bit on the accounts in general is that they're a little bit boring. They don't really talk to many different stakeholders. But if an annual report had this sort of easy to digest information, such as gender gap, diversity, because these are concepts that are not difficult to grasp. You don't have to be an accountant to know the gender gap or the diversity, or whether you're paying a decent minimum wage, or that, you know. And then coupled on with sort of climate related reporting, I think there's a massive scope or massive opportunity, if you like, for government accounts to really elevate themselves and become much more readable, but to be more appealing to a wider stakeholder group. So from that point of view, I would really support it. The IPSAS, it's you know, it's not on the agenda yet. And I think, you know, it's a good point. So they are looking. So, you know, I know the chair would say, well, look, you know, we are a standard setting board. We look at the financial statements at the back, and not so much the front end. But that is sort of changing a little bit now with climate. I don't know if the appetite would be to sort of expand that remit, because if you look at in the UK, IFRS don't say you have to do diversity reporting. The IFRS don't say you have to do climate. All this comes from the company law. So again, then it becomes jurisdiction related to say you have to report on that, and then having maybe linking that to your international organizations like UN and World Bank. I know that they often sort of have that leverage and say, oh, you know, we expect you to start reporting on these issues, you know, for future funding. So that might be an avenue to go down. But, you know, I do know that, you know, if I think of some jurisdictions, I mean, it could be politically quite sensitive, right? And we always have this sort of saying, you know, accounting standards are great for transparency, but sometimes politicians don't always want to be that transparent. So, you know, you can sort of see some potential issues cropping up on that front. But I think, generally speaking, just from a transparency and accountability point of view, I'd be really in favour of it.
I agree. We've got 30 seconds left, and we've had a question from Stuart. So this is our sort of, one line answer time. But Stuart McLeod is one of the key experts on the Albania project. It's great to have you with us. One of the issues putting countries off the implementation of IPSAS is that they're too complex and onerous. Do we feel that the addition of sustainability reporting makes this much more challenging and therefore less likely to be picked up by governments in their reporting? What do you think, Henning?
In short, I agree. I think that is a massive worry about the capacity of finance teams to get into that space. But what it is on the IPSAS board agenda is to come up with a simplified set of standards, and hopefully that might appeal to certain jurisdictions.
Perfect. So that takes us to 11 o'clock. So I hope that's answered your question, Stuart. Thank you, Henning. That's been fascinating. I've thoroughly enjoyed the last hour. So thank you very much.
Thanks for having me.
It looks like the SITFA person is answering that question, but I don't know what the answer is yet. So we'll get an answer on that. And if the recordings and PowerPoint are going to be made available, I'm sure that'll be looked after from a SITFA point of view. Thank you, everybody, for joining us on this webinar. I hope you've enjoyed it as much as I have. And we hope to see you on another one soon. Thanks, Henning.
Good. Bye. Thank you.
Bye, everybody.